Volatility is a normal part of investing. The real risk is what it makes people do. Today, we're going to discuss an approach designed to reduce emotional decision making and to keep clients focused on the long-term outcomes. Welcome to the Evalesco Healthy, Wealthy and Happy podcast. My name's Jeff and I'm pleased to be joined once again by good mate and business partner Marsh. Welcome along, Marsh.
It's great to be here, Jeff. And whilst this might be airing in a few days' time, I'd like to wish you a happy birthday.
Thank you very much. Very kind. So today we're going to be digging into market volatility explained. So a good place to kick that off is, what is market volatility really?
So, Jeff, volatility is completely normal, and it's effectively the price that you pay for liquidity. But because of that, every day the share market and the companies that are listed on it are going to go up and down, and it is completely normal.
So the question then really becomes, how do you design a portfolio and a process, I guess, which reduces the chance of making mistakes as a result of that, which we're going to really dig into today.
Yeah, definitely. I'm looking forward to that. And when you think about the volatility piece, it's there, it can't be avoided. Brace it as though it's your friend. But the danger is not so much the volatility itself, but it's the behaviors and activities or actions that it can sometimes encourage you to take.
Yeah.
And a lot of that links back to, if you think about the way in which we interact in our daily lives, if something happens that's unexpected, we panic. And it's not so much the event itself that often causes the most harm, but it's how we respond to that event. And when it comes to the share market, when volatility hits, without, the right support mechanisms in place, people might sell at the wrong time. So you're effectively selling low and then re-entering several months later when the markets are high, but you feel good about it.
And so it's really, that panic, which is what we're designing portfolios and processes to avoid. Why don't we panic here at Evalesco for our clients and in putting together portfolios?
Number of reasons for that. So firstly, experience. We've been through multiple cycles and we're still here. And when we first got together, Jeff, in 2008 or thereabouts, is in the midst of the GFC, and the market was substantially lower than it is today. And since then, experience has guided us through multiple events of that magnitude. Now, in terms of the portfolios themselves, they're purpose-built for medium to long-term horizons. What we're wanting to do is use strategic asset allocation, which is sensibly allocating money between growth and defensive assets, and using a framework so that we can ride through that choppiness and deliver, a consistent outcome for our advised clients.
I think one of the things we often talk about is that we deliberately don't make hero calls as well. So, how does that fit into the philosophy and how we think about volatility?
Yeah, so that's a really important one because, we've been in markets for a number of years. We've seen initiatives or hero calls. So that's allocating money to, for example, it could be a fund manager who has a particular way of managing money and it's dominated by an individual within the business. And, our view is that, we want to make sure that we're focusing on our investment philosophy and the fundamentals, which is strategic asset allocation, minimizing some of those tactical trades. So that could be a hero call, thinking that we're smarter than the market. And sometimes you might get that right, but on average, those that participate in too much tactical trading typically get it wrong. It might feel great at the time. It might feel like you're delivering value, but typically you're incurring excess brokerage. Clients are going to incur taxation, but there might not be a material upside. So there's some of the hero calls. And it goes back to, once again, the philosophy around allocating money to different strategies and different styles so that we're not over allocating or perhaps allowing some of our biases to come through.
We sometimes see in the press or, dare I say, less experienced investors talking about when markets fall, shouldn't we just go to cash and wait for the right time to invest? Why don't we do that?
We don't do that because, there's no perfect time to kind of enter. I guess investing is a lifetime journey. And our experience has taught us that, yes, if you did have a magic wand and you could implement that, that'd be fantastic. Even Warren Buffett, one of the most successful investors going around, and, he's well into his 90s now, has typically been invested throughout the cycles, and he's used his cash flow to allocate monies to new strategies. And our philosophy is certainly all about making sure, once again, going back to that strategic asset allocation piece, on a quarterly basis, we rebalance our portfolio. So that's a disciplined behavior where we're trimming some of the profits each quarter and we're topping up some of the things that might not have gone as well. And so that process also leads to, I guess, the ultimate conclusion that you're not trying to reallocate large swaths of money on a tactical.
Yeah, and I think one of the key points is that you can make a decision to get out of the market, but then you've got to make a decision to get back into the market. And that's often the harder one, isn't it? People saying, well, is now the right time? Or do I just wait for the market to fall a little bit further? Or do I just wait for the market to recover a little bit before I get in? And what often happens is people don't do anything as a result. And then you end up a long time in cash. And, often find that when a market does recover, or a share or a fund or the overall market, that initial recovery period is where a lot of, I guess, gains are made. So being out of the market at that time really costs you a lot of money in the long term.
You're right, Jeff. So a couple of things to consider is that markets, like humans, can overreact to headlines and information because, it's effectively the embodiment of people buying and selling all day, every day. And the one thing that is really important is to consider that markets are forward-looking. So what you're seeing on the screens today or over the course of the next week is people buying and selling with the expectation of better outcomes or, profiting from the existing conditions. So what I mean by that is, let's say markets fall 10% tomorrow and you've exited, but you're waiting for that perfect time to come back into the market. And by the time that you've made the decision to enter, often it's because it's been validated by an external source. You've read a newspaper article where an analyst is saying X asset is now a buy, momentum has changed. But what's already happened in the markets is that they've probably moved 5, 10, 15% because they're forward looking. And by the time someone's written about it, you've missed that bump. And there's all sorts of analysis that talks about if you've exited the marketplace and you miss some of those big rally days, you can really erode your annual rate of return quite significantly.
Absolutely. So you talked about rebalancing portfolios on a regular basis, so quarterly particularly. Another strategy that we often use, which is more at a client strategy level, is when we talk about averaging in and out of markets. So talk us through what that means and why we do things like that.
So averaging in and out of markets, if you're wanting to invest, for example, a lump sum of money, depending on the quantum, we might average in over a period of time. And that's what we call dollar cost averaging. Now, over a shorter window of 3 to 6 months, that can certainly add value. If you're wanting to average in over a period longer than sort of 12, 18 type months, often you're better off allocating the capital initially. Now, that's general advice, and I encourage you to speak with your advisor about that. But the reason why averaging in can be effective is because it's effectively a systemized approach to investing. You're not trying to cherry pick the very best day to invest your money. And often if you're going to do that, if you've woken up in the morning and you've read a headline that might be particularly negative, you might not invest that month and you could miss out on some potential wins or great earnings over that period. So what we're trying to do is ensure that when our advisors are building portfolios, yes, they're building portfolios based on that framework of the investment philosophy, but they're encouraging you to exhibit the behaviors to be a successful investor. And that's all about investing regularly, spending less than you earn, and allocating that difference to good quality assets.
So effectively averaging in, and same principles apply on the way out. If you're drawing against your portfolio, we can use an average process there as well. That's effectively the opposite of trying to time the market.
So I can give you an example at a portfolio level. If on occasion, we do make the decision to exit, for example, a fund manager or a particular portfolio allocation, maybe because either it's underperforming, we see better value elsewhere. And depending on the asset, we might either exit on one day, we might exit over 3 monthly trades, for example. So at the moment, we're in the process of exiting one of our Australian equities positions. They've got a greater allocation to mid caps and small caps. So there's smaller businesses. And we've made that decision to exit from that and allocate that capital to another market participant or fund manager. And the reason for that is because we think we're going to get better outcomes for investors. But that initial investment, the small to mid cap, has sort of struggled for a couple of years. We made the decision to exit over 3 monthly installments as a bit of a hedge, just in case some of those small and mid cap strategies do rally, which is actually what's happened over the last 2 months. So by exiting over 3 months, our clients have benefited from that decision.
What role does diversification play in staying calm and working through volatile periods?
So diversification is really important at a portfolio level. That's it, regardless of your role as an ultimate investor, our role as an advisor or an investment manager. The diversification allows us to effectively allocate capital to different buckets and over the long term, make it more likely we're going to deliver outcomes that your advisor has framed your portfolio. That makes sense.
It does. So we've talked about we're not making big calls. We're not trying to time the market. So what do we do when markets are, messy or a bit more volatile than, the day-to-day?
So yeah, Jeff, you're right. We're certainly not making big calls. And when markets do become messy, we definitely overemphasize the importance of monitoring and governance. So at an IC level, to make sure that we're reviewing the portfolio performance of the various fund managers, engaging with them, ensuring that behind the scenes, their teams and processes are operating sensibly, because certainly we don't want them to panic, because that might lead to poor outcomes. On a regular basis, we're rebalancing, so that happens every quarter. And even if things do get bumpy, we continue with that process. Even if that means markets have fallen 10%, that means that we're reducing defensive positions to divert that capital back into the equities markets after the fall. We've consistently applied that approach since 2017 with that sort of model framework, and it's delivered great outcomes for our clients. And the other important component is to consider that you maintain discipline with what you do. Don't panic, go back to the process, go back to your philosophy, and ensure that it's adhered to.
I think one of the other key points around that discipline is monitoring liquidity and making sure that when things become illiquid, that's when you have a higher risk of permanent loss of capital. So volatility is, temporary paper loss potentially, where your price, your value of your portfolio on day to day can change quite dramatically. If you don't have liquidity, if funds lock up, that's when a permanent loss of capital, and that's what we want to avoid as far as possible.
Definitely want to avoid that. And there's two components to that. One is from an advice viewpoint, ensuring that advisors are building portfolios that ensure there is liquidity there at a client level. And for retirees, that might mean up to 2 years worth of spending in cash and highly liquid assets. And that means that from a client perspective, you should have some degree of comfort that regardless of the volatility, you're going to be able to effectively trade through 2 years of that period, all the while knowing that you're still earning income, still earning dividends, and those buckets are being topped up. Now, from a financial advice viewpoint, going a level above that, or even an investment manager viewpoint, we do consider it really important. And this is going back to our learnings from the GFC when funds locked up. And, there was numerous instances where a client might have 1% invested in a particular strategy or 3% in an otherwise conservative strategy, but it was backed by investments that are illiquid. And what I mean by that is you might be invested in a managed fund which presents itself as an income fund or a property fund, but that is backed by illiquid assets. So if you're wanting to access that capital, and everybody else is as well, think of a run on the bank, then they can't just sell that property overnight. And so when we build portfolios, we most certainly prioritize liquidity, allocating capital to listed assets versus unlisted assets. And in the short term, that might see, greater levels of volatility, but that also means that you actually have a strong sense that your portfolio is being revalued each and every day. The alternative is, and this is happening more and more in the marketplace, where institutions or some advisors are allocating more capital to unlisted assets with the intent of smoothing returns and ensuring that there's less volatility. I don't really agree with that sentiment because you're still investing in businesses, you're still investing in properties. They're just not being valued on a regular basis. And if you have too much capital allocated to that, when the music stops, there will be some challenges in that marketplace.
Because it comes down to, if you wanted to sell that on any given day, the value would change.
Yes.
It's just they're not being bought and sold as regularly.
Spot on.
What's the biggest mistake investors make in volatile markets?
I think the biggest mistake that it's almost been consistent over the years is spending too much time reading the headlines, too much time listening to the views and opinions of those that are effectively not engaged to deliver you a personal solution or an advised solution. And the best thing in volatile times, if you have an advisor, that is the time when the advisor should deliver their greatest value to you, because their role is to ensure that you're behaving sensibly and taking actions that are in line with your personal financial plan. And the best time to do that is not the good times, but it's how your advisor behaves in the bad times to get you through that period.
Very good. So coming back to today, if we have people listening today and they're feeling anxious about where markets are at or their portfolios, what should they do?
Well, the first thing that experience has taught me is anxiety comes to play or comes to the fore as a result of an absence of a plan or a series of actions that you can take to secure your future. Typically advise clients that have a very clearly articulated plan. They know what behaviors they need to take each month to create long-term success for themselves and their families. Typically leads to less anxiety. So the first thing I would do is, if you're having any thoughts as to what should I do, I'm a bit nervous about the marketplace, is to speak to a licensed financial advisor and to engage with them, share your concerns, share your priorities, your hopes and your dreams, and look to engage and create a relationship with someone that can support you throughout that journey.
Mm-hmm. If you're working with an advisor and you've got a bit of a plan in place, we don't want anyone to be reactionary, but I think a couple of simple things is just to go back and check in on your plan and make sure you're aware of why you've got your portfolio structured as it is. Look at the longer term picture, where you're heading. Feel free to get in touch with your advisor and just say, is there anything I should be doing right now? Hopefully they'll tell you stick to the plan, and then the long term that'll play out well.
It should. And going back to sort of something you touched on there, if we've got listeners to this program and they've already got an advisor, but you've been asking questions for a little while, it's possible that you don't fully understand all of the components of the plan. Maybe you haven't asked enough questions, or perhaps you've got to the point where maybe you need a little bit more, and the advisor hasn't done a good enough job articulating the strategies that you're in and why, and what behaviors you need to exhibit. So, with that in mind, I would strongly encourage you to, pick up the phone and have a chat to your advisor. And, if that advisor is someone else, I strongly encourage you to have that as the first port of call. Mm-hmm. But then if you're not quite sure of the answers, then give us a call.
Sounds good. I think that's a good place to wrap up. Hopefully some reassuring advice for people living at home, listening at home. If you have any questions, please do not hesitate to reach out to the Evalesco team. Thanks, Marsh.
Thanks, Jeff.